If you see the long-term performance, the fund has completed 7 years, almost 7 years, 8 months. And in the next 4 months, it will be a full 8-year-old fund. So the track record is very longevated. The fund was launched in March of 2014 at a starting NAV of 10 rupees. The current NAV as on December 31st, 21 was 35. So the fund is up 3.5 times, translating into a compounded annualized return of 18%. If you see from 2014 till 2018, the fund was doing exceptionally well. Broadly, the fund was up 2.63 times in just about 4 years' time. And that made this fund the fastest growing fund and the best performing multi-cap fund in that time frame. So in long term, the fund has done extremely well, if you see on this chart. But one point which I was trying to make, when you read into returns and when you read into point-to-point returns, if you see in March of 2020, when the markets corrected by 40%, the 1-year return of the Flexi Cap Fund looked negative 24.9%. And that led to a negative return on a 3-year basis by 5.1% and virtually zero return on a 5-year basis. At the same time, as on December 21, when the 1-year return moved up to 15.3%, 3 years return from negative 5% moved up to 11%, and 5-year return from 2.7% just about a year and a half back went up to 12.5%. Right? So sometimes this 1-year return does have an impact on longer term returns. But if you look at this particular slide once again, pre-COVID correction as on Feb 2020, March 2020 is when we saw the deep correction. But before that, the fund was actually outperforming. So in Feb 2020, the 1-year return was 15.6 against 13.9 of benchmark, alpha of 1.7% on 3-year basis, 2.7% outperformance. And since inception, an outperformance of 6.4%. So the fund was actually outperforming just about 18 months back. It is actually only the last 1 year where the underperformance has led to pulling down of alpha on a longer term basis, which can very, very quickly reverse as we go along. Now, if you look at the returns from rolling return perspective, this is a better way to look at the long-term performance of the portfolio. So we've looked at a 3-year average rolling return period. And on that basis, the fund has 5 periods of 3-year rolling returns. And I'm happy to say that 4 out of 5 years, 5 3-year rolling return periods, the fund has actually outperformed. Between 2014 and 17, the fund outperformed by 3%. 2015 to 2018, the outperformance was 4%. 2016 to 2019, the outperformance was 4%. 2017 to 20, it looks 0, but if you add 2 decimals, there is an outperformance. So it's basically this period 2018 to 21 with a negative 3% of underperformance. It's only one 3-year rolling return period where there we have found that there is a underperformance. But for those long-term investors who have sat through the fund for 5 years and more, broadly would be seeing outperformances in their portfolio. Whereas some investors who would have invested in this period 2017 to 2018 is where they would be experiencing some amount of underperformance. But I would suggest and recommend that when you are appraising any fund, rather than looking at only point-to-point return, it would make sense to also look at rolling returns on a 3-year basis or on a 5-year basis. It will give you a better perspective as to how the fund behaves at different points of time and different periods.
I'll try and take you through what has essentially transpired in the fund in the last 18 months, the period where essentially we have seen the underperformance, because of which perhaps the long-term track record on a 3-year, 5-year, as Akhil also mentioned, is not looking so attractive. So essentially, to start off, I think 2 things happened. If you look at the essence of how this fund has always been run, it's been more like a owner's fund in the sense, what I mean by that is that, capital protection here has been the number 1 priority. This has been the fund, or if you look at Mr. Ramdev Agarwal himself, he's been strongly influenced by Mr. Buffett. And, his rule number 1 is to protect money and not lose money. So during this COVID period, I think what has happened is one of the things that now looks like is that perhaps we were not, very quick to be very aggressive, and we had a more capital protection kind of a perspective, because of which two, three things happened. We continued to be more, focused on the large cap side, and also we did not try and, look at some of the very sharp economic recovery plays which didn't have the right fundamentals, and some of these things happened in a very fast pace, and that has led to some of the underperformance as we speak. Another thing which I wanted to mention is that ours has typically been a very buy and hold kind of a strategy. And if you look at what's happened in the last 18 months, is this fund had a very high allocation towards the BFSI segment. When we say BFSI, while our exposure here was high at say 45, 46% for BFSI, almost 12, 13% of that was insurance plays. And insurance play did not have any leverage risk or any apparent risk other than when COVID came up and on an operational side risk came up. So one was the BFSI, the other was the auto sector, where we were very highly indexed on the auto side. Akhil, if you can just go up once, yeah. Very highly indexed on the auto side, and our exposure was more on companies like say Maruti and couple of two-wheelers. Now, if you look at the returns since COVID, what has happened is the banking Nifty has kind of lagged the overall Nifty 500 returns. Nifty 500 returns being more like 150%. The banking index returns being more like 110%. And within that, surprisingly, some of the very pedigreed name, which appears very, very attractive, like say HDFC and so on, it's actually underperformed some of the other banks. Now, if you look at HDFC Bank, it's been a major wealth creator for decades now, and it's trading at its all-time low valuations on a price-to-book basis and so on. And all the issues which it recently had, whether it be with regard to credit card, whether it with regard to leadership transitions, those things are now behind and it's coming back. So some of these things led to the underperformance that you see. If you come to the next slide, Akhil. Akhil, if you could change the slide, yeah. So if you look at it here, essentially some of these things like having a higher allocation to BFSI, auto index, and not being present in the metal index, any of the metal stocks, this has seriously impacted our performance. When you look at the drag, I think a large part of that drag would be explained by what we are seeing right now here. That is not having the metal stocks, which went up very sharply, between the period of say the lows of COVID to the next 12 months, where many of the steel stocks, aluminum stocks, they went up 4-5x, and some of the other ones which I mentioned, which is having a higher allocation to BFSI and the auto index. Next slide. Okay. So what has happened is since then, obviously, we have reallocated some of the sectors, and as we speak, some of the major divergence has already been corrected. When you look at the BFSI side, our allocation has come down from what it used to be at a peak at around 48-49%. Similarly, in some of the other sectors where we did not have allocation in the past, like when you look at the lower chart here, like say whether it be cement, whether it be industrial capital goods or infrastructure companies, or say healthcare companies. So those are some of the segments where we have added. And I would now, in the next slide, try to show you as to what are the additions and how, we have currently positioned. So so the larger, just to summarize in this slide, like when you look at the lenders, we are now down to around 32% only versus say a time when, this was much higher. And the Nifty 500 weight itself is around 27%. Insurance is a play where, we still have an higher exposure, but this is a segment where we believe that a lot of the issues that we saw here, where one time, and the companies here are companies which are set to create wealth over a very long period of time, and these are probably better proxies than some of the consumer names that currently. So this is almost like a consumer proxy for us. And even in autos, we believe that all the issues that we have seen in the sector over the last, say, maybe 12 months, 15 months now seem to be behind, and this is a sector which looks really ripe for coming back in a very strong way. So the point I'm trying to convey from this slide is that what led to our underperformance in the last, say, 15 months, 18 months, almost uh, all these sectors or all these conditions are now changing very significantly. Like whether you look at the lenders, they are now looking very, very attractive. There are no issues there. The COVID provisioning is done, and they are trading at perhaps their all-time low valuations. When you look at when you compare them on a relative basis versus the index, banking is perhaps one of the few sectors which is at a discount to its long-term 10-year valuations, versus most of the other sectors, which are in fancy, they are trading at almost twice the standard deviation away from what their mean valuations have been. Same for insurance. We think it's, the kind of a growth you will see on the Europe side here would be much stronger than what you will see in any of the consumer companies and the auto. So we think that, what led to our underperformance in last, say, 1.5 year is likely to reverse in a big way when we look at over the next 6 months to 1 year. Next, again. So these are charts which are trying to, show as to what kind of projections most of the analysts, this is a consensus analyst estimates on what kind of earnings growth you're likely to see on the automobiles, bank private, and the insurance on the EVOP side. So across these three segments, the growth which is going to come back is going to be very strong. So again, just going back to the point that, I mentioned in the earlier slide, that we think that, the 2-3 sectors, the fact that we were over indexed on the large cap, did not have much of did not have much of mid and small, which hurt us very badly in the last 12-18 months, is turning around in a big way, because today the large caps are probably as attractive as perhaps they were when, if you remember, in the last time when you saw a huge mid and small cap rally starting from, say, 13 to 17, and then the period between 17, 19, 20 was a period when large caps came back very, very strongly. So I think that's the kind of a time period, that's the kind of a scenario we're seeing today. So as I was mentioning to you, what we have also done is, in the recent time, we have added quite a number of new stocks to our portfolio. We have tried to realign it towards economic recovery themes, and also towards some of the new avenues which are opening up. So, whether you look at a Gland Pharma, which is obviously, one of the recent IPOs which came last year, towards the end of 20, that's done very well for us. Same for Zomato. These are both very large holdings for us. They are in the top 10 holdings for us. Then SBI Life is, we rejig within the insurance portfolio, and that stock has done much better than some of the other insurance companies. In the recent time, we've also increased our exposure towards capital goods by introducing both ABB and Siemens. And we believe that, both these stocks will do something which is very similar to what some of the consumer companies did in the last, say, 4-5 years, where the retail segment, whether some of the consumer companies continue to see very strong performance. So I think with the capex recovering, and these companies are not just a play on capex, they are a play on modernization, they are a play on digitization, they are a play on brownfield expansion. So we think these two companies will do very well. So we think we have, in the last 6 months, since June, that we have taken over, we've done a lot of these changes, which has aligned the portfolio to more on the economic recovery themes. Yes. Now coming forward to obviously what has happened in the last 15-18 months, the idea is not to kind of give that as a this thing. That was more a effort to explain as to why we may have seen a lag in the last 12-18 months. Now going forward, our focus has always been that we look at the some of the key metrics for the portfolio, and within that we give importance to all the QGLP, the 4 points that you have. So in terms of quality, when you look at this portfolio today on a 24th, it's a 18% plus ROE portfolio versus when you look at an index, it would be lagging more in the 13-14% range. If you look at the growth side, so if you look at the growth side, we are looking at more like a CAGR of 26% versus Nifty, which is 23. And this 23 is also driven very sharply by one or two sectors for the index where, the other metrics like say ROE and so on does not stack up that well. On a peg basis, we are again better than the index. So our sense is given the superior portfolio metrics that we have, we remain confident that when we're looking at it over the next 2-3 years, the fund should again come back and start performing the way it has historically done. Next, again.
Maybe you can explain this also. I mean, some of the specifics in terms of the portfolio monitoring template.
Yes. So, as we mentioned that, we have this framework of QGLP, and all our portfolio, we try and have a template which kind of gives you a very good peep into all these four parameters, whether it's quality, whether it's growth, whether it's longevity, whether it's price. So if you look at the top 10 holdings of this fund today, invariably, the earnings growth here is very, very strong. When we are looking at a CAGR of 26% on a like-to-like basis in their respective segments, it's very strong. Then, what we try and do is we try and have them at a very reasonable peg, which is the price-earnings ratio, price to earnings growth ratio. And, when you look at the peg number here, it's very attractive at 1.5. In fact, if you leave a couple of ones where on a 3-year basis, the peg would be higher, but that is higher because the growth here is very, very strong. And, for very high growth companies, the peg ratio also goes up. So as such, when I look forward on a 23-year, for the financial year 23, the P ratio for this fund is more like 24%. I think our earnings growth going forward, what we see is upwards of 24-25%, and the peg ratio is very attractive. Some of these companies have in the recent time not done so well, but they've been wealth creators for long, and I have never seen these companies available as attractive as I see them today, whether it be HDFC Bank, whether it be TCS on a relative basis. While on a PE, TCS has gone up, but on a relative basis across sectors, across IT companies, TCS perhaps looks one of the strongest one. Same for Infosys, same for HDFC, same for Maruti. So, when we look at the portfolio, we think a lot of these names have been, they have proven themselves over decades now. And, you have never had them at such attractive valuations and growth opportunities in the recent time. And, we are highly indexed to most of them.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.